Hi everybody, it's Clarke Camper with the April 2013 edition of Wall Street and Washington. Today I'd like to cover four things. First, I'd like to say a few words about the SEC's proposed Reg SCI. Second, I'd like to talk about U.S. equity market structure. Third, I'd like to talk about the pace of rulemaking at the CFTC. And fourth, I'd like to talk a little about the search for a potential alternative to Libor. First, in terms of Reg SCI, I love the name. SCI stands for Systems Compliance and Integrity. If ever there was a rule that's described by its name, this is it, because this rule would require a whole new array of technological testing and reporting requirements. There are a couple things that I think are noteworthy about this rule. First, it applies to many entities other than just exchanges. It applies to SROs, to clearinghouses. Notably, it applies to ATSs, many dark pools. The SEC, by its own calculation, says that approximately 44 entities would be covered by this rule. Second, the cost of compliance is not inexpensive. The SEC says that one-time initial costs associated with the rule would be just a little less than $250 million, and they estimate that ongoing costs would be a little less than $200 million a year for the industry. So again, as you can tell from those two pieces, if you have any doubt about whether Reg SCI applies to you, to your organization, check it out now. The SEC is taking comment through May 24, so now is the time to get involved. That's a nice segue into comments more broadly about the U.S. equity market structure. Made no secret that NYSE Euronext, from our CEO Duncan Niederauer on down, has said repeatedly that we believe the balance of trading on exchange and off exchange is out of whack. We've been asking policymakers in Washington to look at that for some time now. One thing I want to note is that I see a new line of concern among U.S. policymakers that's just beginning to resonate, and that is global competitiveness. In the last few months, both Canada and Australia have instituted some new significant requirements that push a lot of trading from the dark onto public exchanges, and policymakers in Washington are watching those developments closely and starting to wonder whether U.S. equity markets may be disadvantaged in terms of competitiveness with other markets like Australia and Canada. Again, just a germ of a focus right now, but my instinct is that concern will grow among U.S. policymakers. Third, I'd like to move over to the CFTC and comment about the pace of rulemaking. The real noteworthy thing really is what's not happening, rather than what is happening at the CFTC. By my account, in the first 2 years after Dodd-Frank was enacted, CFTC had 28 public votes to vote on rules to implement Dodd-Frank. Since July of last year, they have had no public votes to implement Dodd-Frank. Now that doesn't tell the whole story, right? That's not completely fulsome in its description of the situation, but it is absolutely directionally correct. The fact is that there is a lot of internal disagreement at the CFTC about how to proceed, particularly around finalizing the swap rules and rules applying to CEFs. For instance, the major CEF rules have been pushed off now in terms of a public meeting to approve them. Month after month after month, Chairman Gensler is now saying that in May sometime they'll have a vote. But I do not see the pace of rulemaking picking up in coming months. I think, what does that mean? Well, I think the real issue is the longer that we go without some delineation of the swap landscape, the more I think swaps and CEFs are going to be disadvantaged as we move forward, because we've seen many entities already, for instance, some swap players already filing to become futures exchanges. They don't want to wait for these rules to be implemented before acting. Finally, I want to say a few words about Libor. Everywhere I go, people say to me some version of, do I think the US government, one way or another, is going to get involved and try to encourage an alternative to Libor? The simple response, from my sense, is no. Chairman Gensler has been very vocal, and I've said many times he's made some very compelling and I think very reasonable arguments about why Libor is broken and why we need alternatives. The fact of the matter is that I do not sense, for whatever reason, a real appetite among US policymakers to actually take up that issue. So again, in the short run, I certainly don't see anything significant in terms of US-related developments to Libor. With that, I'll wrap things up, and we'll see you next month on Wall Street and Washington.